What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is October 30th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we're going to cover the big picture topic of generational cycles and financial assets. I not only think this is an imperative topic to discuss in regards to Bitcoin, and it's one we haven't covered in a long time here on this channel, but along with that as well, this is a topic that I think is imperative to discuss, especially as many people are starting to anticipate a full swing bull market going into the next year as a approved Bitcoin ETF may be in the cards in the next few months. So I want to spend some time to discuss this and really try to answer this fundamental question. Are we at a time period where we have the steam and the ability to continue climbing higher? We've got a lot to unpack here in today's video, so if you guys happen to enjoy this video, consider dropping a like. It's one of the greatest ways you can support the channel, and let's go ahead and kick off the conversation. All right. So I want to spend some time here to dive into Bitcoin's chart and specifically talk about this ETF talking point. We can see clearly here, as we've set a new relative highs over the past week or so in Bitcoin's price with the recent rally, that a lot of people are starting to price in a likelihood of an ETF happening. And again, we're not here so much to debate whether or not it's going to happen or not. I want to focus in on the important question that we've discussed for months, and that's whether or not we've got the inflow demand for a Bitcoin ETF. I think many people, whether you're bullish or bearish, understand that the ETF is a potential catalyst to continue accelerating prices, because as assets grow larger, their appetite for dollar liquidity and new participants gets even bigger. The mass of an asset as it grows over time demands more dollar liquidity in order to sustain those valuations. So for example, in the last cycle, we found that catalyst was stablecoin liquidity. We went from around an average stablecoin liquidity at the time of around $5 billion all the way up towards $135 billion in a little over 2 years, a 27x in the amount of stablecoin liquidity between Tether and USDC that was available on the order books and cryptocurrency exchanges. And while I will absolutely concur that at the end of the day, a lot of this liquidity might have gone to stablecoins, altcoins, and other players in the market like Ethereum, as well as XRP and BNB. At the same time, a lot of this initially goes into Bitcoin. We can see that liquidity drives direction. Well, after a near 20% pullback here in stablecoin liquidity, we're not seeing any real nudge up here. With all the FOMO and optimism that a lot of people are feeling, stablecoin liquidity has barely budged here. So we better be relying on this ETF providing enough inflows into the space if we really expect a new bull market to come. The question is, how much can those inflows really be? Well, in this month's newsletter for the Dash Report, we covered this topic where we dive not only into our kind of updated thought process and our strategy into about how to invest in Bitcoin or how to kind of make sure we hedge ourselves in either direction, but outside of that as well, how we actually can expect the Bitcoin ETF to impact prices. And I think many of you might be surprised from a lot of the overt optimism in the market that there may not be as much liquidity as many people might think. If you're interested, I recommend you guys check out the Dash Report down below in the description. And I do want to let you guys know that while we've kept the price for the Dash Report the same since back in 2018, we are now looking towards increasing the prices by the end of this year, going into 2024. So if you guys want to lock in that rate, if you want to be grandfathered in to the current rates, you guys can do so. You can get a 20% discount for the newsletter at $240 essentially on a yearly basis. If you guys want to do the monthly though, in this case, so you can cancel at any time, essentially it's $25 per month. But that's it though. I just wanted to let you guys know that you can access that down below in the description. There's a ton more other than the newsletter. You also get the Trade Alerts group. You guys get the Dash Report discussion group, the mid-month webinar where you can ask me questions. We dive through the charts, a whole range of stuff. So if you guys are interested, definitely check that out. But let's go ahead and spend some time here to talk about the generational cycles, guys. What we're looking at here is a chart of the S&P 500, the broad 500 top most valuable stocks in the US markets, basketed into one index, going as far back as 1871. Man, that's a long period of time. Over 150 years of history we have here to work with. Isn't that amazing, the data that we have available here? Well, if we aren't looking back at history, we're going to be missing the big picture, guys. And what we like to focus on here on this channel is that big picture. We like to think in long-term time frames. We're not analyzing the 5-minute chart or the hourly chart or the 4-hour chart. In many cases, not even really diving too deep into the daily. We look at the weekly, monthly, the 3-month, 6-month, 12-month candles. We want to look over a long period of time here. Now, one thing that I really think is fascinating here is when we zoom out, we can see cyclical trends in financial markets. Going back really here, since this period of time in the 1800s, we can find that we see generational expansions in valuations of assets over certain windows of time, and we see corrections in those assets, right? So we can see that there are steady pullbacks sometimes. They can vary to a certain degree. Sometimes it's not that we per se pull back and remove 30, 50, 60, 70% of valuation in these assets, but that we essentially kind of push sideways for a period of time. So that can vary. But generally speaking, we can see that there are windows of time where it is easy breezy to ride the wave on financial assets, where it's easy to make essentially what I call dumb money. You don't have to do anything. You just put money into the financial markets, and you not only probably hedge against inflation, but if you play your cards right and play it safe and don't fall for a lot of different traps of day trading, doing all these things, you can make generational amounts of money. And that's the key goal at the end of the day, right? That's not me upselling you guys. I'm not telling you about my course or ultimate strategy. That's just history, right? That's what history shows us here. That's number goes up and to the right, as a lot of people say. Well, generally speaking, these periods of time last over certain windows of time. As we can see throughout history, these used to last a little bit longer, right? We used to see a 66. In this case, we're looking at the 6-month chart, by the way, just to let you guys know. So each of these candles represents half a year. So we would see that generally speaking, these could last a little over around 30 years here, these kind of expansionary cycles from, in this case, 1897 all the way here towards around 1929 during the Roaring 20s, going into the Great Depression. Here from the 30s going here into the mid 60s. And you can see that these are huge waves of opportunity here in financial assets. Now, some people here may look at this chart, what I have printed here, and we can see that we've had a 574% expansion, essentially speaking, over the last 13 years, coming from back in 2009 here towards more specifically November of 2021, if we really get into particular dates. And some people might say, well, Nick, don't we have a ways to go here, right? Couldn't this continue expanding here? And I'm not going to go ahead and discount and say that that can't happen. But I want to go ahead and dive into a more important chart here that's going to help us to determine and answer that question. It shouldn't just be me guessing that, oh, no, it's going to go down or it's going to go up. We should look at a chart that's going to signify to us whether or not assets are trading at a premium or at a discount. So I want to go ahead and show you guys a really interesting chart that we rarely cover here on this channel. You guys are in for a really interesting treat here, I think. This is one of my favorite charts out there. And essentially what we're taking a look at is the S&P 500 divided by the money supply, or M2. Now, what's great about this chart is that because M2 has a long dated history here, a broad measurement of all the money that's in circulation, TradingView has this data set, and it also has the history of the S&P 500. While we don't have it all the way back to, say, the 1800s like we do for the S&P 500, for the M2, we have history up and towards the late 50s or early 60s. And this gives us a really fascinating chart that I think should definitely be kept on your radar, and you guys can add to your watch list. If you want to have this, you simply type in SPX. I'll go ahead and clear it out here so you guys would know how to type it. SPX, and then you divide it by M2SL and hit the down arrow, and there you go. You've got the Federal Reserve's M2 money stock measurement. So that's how you build a chart. But essentially, from this, we can gauge some really interesting data points. This essentially showcases significant windows of time where assets are either accelerating against the base money supply or deaccelerating. Put in another way, where people are paying an increased premium on the valuation of companies and generally assets as a whole, versus during periods of time where there's starting to be deacceleration. People pay lower PE multiples. People are less optimistic about the future versus the money supply, right? So essentially, if we are seeing acceleration here, even if the money supply may be expanding, asset prices are expanding faster. And we're also seeing periods of time where we have corrections against the money supply. Even if the money supply, as it usually does, is expanding up and to the right, there are periods of time where still assets are less attractive here. And there are all the types of different reasons for this here. But generally speaking, we don't care so much about what the reasoning is. We don't care about the headlines or the catalysts. We care here about whether or not we're going up or we're going down. Because if we're going up, we want to be on for the ride. No ifs, ands, or buts, no arguments, no global macro concerns. If this thing is ticking up and to the right, we want to be on the ride, and vice versa. If it's going down, we want to be in cash, and we want to be defensive, and we want to protect and preserve our purchasing power. Well, let's go ahead and take a look here throughout history. We can see from the 60s going into the 70s where we had heightened rates of inflation, that generally during that period of time, as essentially the money supply was still expanding and we had heightened inflation in the economy, people had less disposable income, we saw a deacceleration here, right? And this was a period of time while there was technological innovation, we really didn't have something that was big enough here for people to get really excited about that could really alter productivity to such a heightened degree, right? And that is where essentially we later on, at a very dramatic discount against the money supply, saw a massive reacceleration from the 80s into 2000 in the age of hardware, software, and the internet. A new birth of technology that got people incredibly excited, right? And the transformation that those technologies provided towards productivity, the quality of life, were insurmountable here. And that's just some of the technologies that happened in this period of time. And no wonder we started to see a premium paid on these stocks. And I'm going to talk about how this all comes back here to crypto and the stock market later on with where we are now. But I hope you guys are seeing this here, that during this period of time, there was huge transformation, and it makes sense that people would pay a higher premium on assets, that stocks would just be soaring, generally speaking, during these periods of time because there was so much technological innovation. Well, we saw here during the 2000s, up until 2009, that while the internet was finding its place, while consumer internet was definitely a thing, it overshot in the 90s. The expectations were priced in too quickly and too aggressively and got too euphoric. And that's why even as the internet was still expanding, and as always, technology is improving as time progresses, it's never going to turn backwards, right? Essentially speaking, we can come here from 2000 to 2009, and we saw that during a really powerful recession during this period of time, and also the cool down from the dot-com bubble, we came down towards the lower band here, not seen since back in the 80s versus the money supply. That's how brutal the dot-com bubble collapse and the 2008 recession were on the price premium of assets. And this is very impactful stuff here, guys. We're talking about from that high towards the low here, losing out against the money supply by 75%. 3/4 correction versus that. So if you were buying during that period of time, you could have lost serious generational wealth. Now, from here on out, we can see from 2009, we saw re-acceleration in the trend from those lows, up about 167%, and not to mention towards a very significant level. This was the level where we faced resistance in 2007 and back in 1961 versus the money supply. This is no pure coincidence, guys, that we're seeing resistance around this similar range. Right? This is historically significant stuff, and it's the same reason why we bottomed right around this range down here, right? The lines here aren't meant to be exactly on point here, tell you exactly the right levels, right? Generally speaking, though, they are a given range of discount opportunities and premium opportunities. And while there is a chance here, I think that some of you who are more optimistic might be saying that, hey, Nick, we might be able to continue like the dot-com bubble with AI, not to mention maybe cryptocurrencies and DeFi, and we're going to see some massive acceleration here towards these higher levels on the chart. Maybe that can play out here, but you also need to consider here whether or not we could cool down here, coming here down 30% down towards the lows from March of 2020, or coming down here again back towards the range we saw in 2008, or even worse. As we are on the upper band here, there's even a chance you could come down towards here where we were back in the 80s. Now, I'm not going to call for that here today, and that's not where my opinion stands. I don't think it's going to be that brutal, and we don't exactly have to zigzag here towards any fixed range. We clearly saw that here in 2000. This was an anomaly here. We don't have to come all the way down here like we did, say, back in the 70s and 80s. That being realized, I want to go ahead and make it very clear here, guys. No matter where you stand here, I'm not here to tell you whether it's going to come up or down here. Right? You already probably know our opinion. We lean a bit more bearish here at the moment. But it's as simple as watching this chart here. We have faced a lot of resistance from 2020 to 2023 at this range. And while we haven't significantly pulled back here outside of March of 2020, we need to see something give here in the next 6 to 12 months. In 2024, we've got to see some return to optimism here, and it's got to come here pretty soon, because essentially if it doesn't, this is starting to look like we've got not only this line of resistance here, but we might have a descending line of resistance, further confirming that we got to come down here and spend some more time at these discount ranges as AI hypes start to cool down and fundamentals start to come back into play, as the Fed and other central banks have to still probably over the next 12-18 months deal with the issues of inflation, as we're still stuck for the past few months at an annualized rate of 33.5% for inflation. This is really a difficult period of time. And again, at the end of the day, right, let's look at the additional charts that can help us to gauge this. Now that we understand the significance of these valuation ranges, well, the US 10-year minus 2-year yield, or the yield curve, is uninverting. This is a recession sign. So that is not going to help us if we're having a hopeful outlook on a kind of price premium multiple on assets. The volatility index has pivoted or deviated back right above the ascending line of support, and volatility is inverse of equity acceleration. So this means that equity prices are declining. So the price premium, the uncertainty, is coming into play, and people are paying less of a premium on assets. This is not helping. This is another bearish sign here. And we have global liquidity still continuing on a half-year basis here, time and time again, since back in 2022, continued to decline significantly, not basing out and not accelerating, right? We can even dive into the more shorter time window just to kind of show you guys, well, it has slowed down here. We set in new lows back here in September, and we aren't getting any serious acceleration like we did when we had some sideways price or sideways move in liquidity here up into November 2022. After a year later, we've continued to set in new lows here, and it looks like we're heading even lower. So liquidity is not on our side. Volatility and uncertainty is picking up. The yield curve is uninverting, one of the most consistent signs of a future recession in the cards. And no matter how severe that recession is going to be, I think that's up for debate, all these things are working against asset prices. There's less money in the system. As we talked about, that is essential for assets to really move up sustainably long term. It's why we continue to take a look here, not only at the S&P 500 and Bitcoin, but mainly looking here at stablecoin liquidity and looking at the ways that we gauge the growth or deacceleration of liquidity. Now, I want to go ahead and again talk here about this topic of generational cycles, because over the last decade, not only did Bitcoin do phenomenally well, but we also had altcoins. We had so many narratives build up over the past few years, and albeit most of it was in, say, 2017, right? We're not talking about the same time frame here. Altcoins and crypto as an industry is much more fast moving, right? And that can be both to the upside and downside here, right? Essentially, though, since back in April of 2023, we've been setting in lower highs here for the actual dollar value in the total dollar market cap of these altcoins. And I think, as we've pointed out rightfully so over the past year, that we're seeing the long-term lines of support for altcoins versus BTC setting in those higher lows over time, up and to the right. Now those lines are being broken. Those previous multi-year lines of support that hold incredible significance are being broken here. We see ETH, BTC, its line of support that goes as far back as December of 2016 here. Guys, 7 years of price action coming up here on this December. It's going to be 7 years of previous support, practically speaking. Just got broken here for the first time. BNB, third largest cryptocurrency here. We can see that is really close to breaking its line of support here. It's coming into the value box we talked about here back a few months ago when BNB was up here at 0.085. Now it's come down here towards 0.066, and essentially we got to see whether or not it's going to hold on this line. If it doesn't, that signals trouble here. That signals a lack of optimism for a huge chunk of cryptocurrency markets that drove liquidity in the past. And on top of that, we can see Cardano snapping through its line here. It looks like it might be catching a bid. We'll see if that continues to hold here. Could very well. But we can see here on XRP a clear breakthrough on the near-term line of support, and looking like it's ready to come back down into the usual capitulation range we saw, say, in February 2017, in July of 2014, or here in December of 2020. Right? So I'm not saying that their dollar value isn't going up here, guys. Of course, yeah, altcoins have gone up here for the past few days. Bitcoin's moving up. But the thing is here is that we're not seeing a continued increase in the risk on tolerance here for these names. And while that's normal here for this period of the cycle, the thing that stands out to me is that when it's time for them to catch a bid, when it's time for them to revisit those historic lines of support for the last few years, not to mention the ascending line of support, it's showing that there's a decreasing appetite for risk. And I think it's indicative of a long-term trend for assets as a whole. That while we've had some short-term optimism here, while we've had what I believe is a very exacerbated relief rally, I don't think we really have the steam to kick off that new bull market. And it goes even further when you understand even those who are most optimistic in this space, their expected inflows for a Bitcoin ETF. And it gets back to that fundamental question, are we gonna have more market buy-side pressure or more market sell-side pressure? People who are looking to buy Bitcoin at the best available price versus sell it. And I have to tell you guys, as Bitcoin's price moves up here in the near term as it has, I think you're going to find that there's not enough steam to continue carrying forward, and that sell side pressure is going to pick up as people again get to sell their positions at a higher range from where it was back just a couple of months, the past year or so. I think this is a fundamental dynamic we need to understand here. And again, if you guys are interested to kind of get that analysis, I recommend you guys check out the dashboard. We'll eventually talk about it later down the line here in this channel as time progresses, but it is something that I really want to spend some time. I can only really do so in a long written format where I can go through and dive through the charts. So if you guys are interested, check that out, the link down below in the description. You guys can get grandfathered in towards the rate we've had for the past few years in this channel. It's a really nice discount rate, essentially, before we increase prices later next year. It's a great way you can support all the free content we do here in this channel, plus get an additional 33% of additional content like our trade alerts, the mid-month webinar, where you guys can interact and ask questions, all kinds of different stuff out there, plus analysis on stocks, commodities, and Forex outside of crypto. So we're really doing a 360 perspective on financial markets. But above all, guys, I hope if you take anything away from this video, it's to understand that if you don't get this right, if you don't get these periods of time where it's really not beneficial to invest in equities, where we either go sideways or we decelerate lower, you can eventually lose out. You can lose opportunities, whereas you'd probably be better off with more defensive plays. And I know it may seem like it's too soon for one of these to happen following 2008, but things change over time. And it's going to be a matter of watching that chart, that premium that people are paying, because if the market isn't paying that premium, we should be playing defense, not offense, and waiting for better times, waiting for more capitulation where we can really get those discount opportunities. And I promise you guys here, this does play a role for crypto, because just like stocks, crypto is thirsty for liquidity. And if the river's dried up, you're not going to get your bull market. It's as simple as that, guys. Anyways, that's it for my thoughts here today, guys. I hope you enjoyed the video. Again, if you liked it, consider dropping a like. It's one of the greatest ways you can support the channel. If you're interested, check out the dashboard down below in the description. Until the next video, guys, I'll see you on Wednesday at 6 a.m. Eastern Standard Time. Take care and have a wonderful start to your week, everyone.